Are you tired of the same old investment advice that just doesn't seem to work anymore? We've all been there, following the conventional wisdom only to watch our portfolios underperform. But what if I told you there's a secret weapon out there that can change everything? It's not some kind of magic bullet, but it's also not what you're thinking. Today, we're going to dive into 5 game-changing ETFs that have the potential to supercharge your investment strategy and help you finally achieve those financial goals you've been after. And the best part is, these aren't your run-of-the-mill index funds or basic commodity plays. These ETFs are unique, innovative, and designed to give you an edge in today's ever-evolving markets. So if you're ready to take your investing to the next level, then keep watching. The future of investing is here, and it's in these 5 ETFs, okay? So when it comes to investing, most people think that you need to choose between 2, risk and reward. You can either play it safe and go for a more conservative investment, or you can go for broke and invest in something more risky. But wouldn't it be great if there was a way to get the best of both worlds? Well, with the Global X NASDAQ 100 Covered Call ETF, that's exactly what you can do. This ETF is designed to give you exposure to the NASDAQ 100 while at the same time collecting dividends from selling covered calls on the underlying stocks. But why is this such a big deal? Well, let's face it, the NASDAQ 100 is a powerhouse index. It's made up of 100 of the largest domestic and international companies listed on NASDAQ. And it's a great way to invest in some of the most innovative and forward-thinking companies in the world. But on the other hand, let's be real. The stock market can be a roller coaster ride. One day you're up, the next day you're down, and it can be tough to know which way is up. But that's where covered calls come in. By selling covered calls, you're essentially entering into a contract that gives you the right to sell a certain number of shares of a stock at a specific price on or before a certain date. And the best part is that you receive the premium for that contract up front, which means you're getting paid just for entering into the contract. So how does this work in practice? Well, let us say you buy 1 share of Apple for $100. You could then sell a 1-month $3 strike call option on that share for around $15. If the stock is above $103 on the day of expiration, you keep the $15 premium and keep selling cover calls each month. The stock is below $103, you still keep the $15 and keep selling cover calls. Now, if you're like me, you're probably thinking that sounds pretty risky, but let me tell you, it doesn't have to be. In fact, this ETF has a pretty low standard deviation of 13.42%, which means that the returns are relatively consistent and predictable. Plus, if you're worried about the stock price dropping, don't be. The Global X NASDAQ 100 Covered Call ETF has a beta of 0.65. which means that the price movements are less volatile than the overall market. So if the market goes down, this ETF will likely go down, but at a slower pace. And that's just one of the reasons why this ETF is so unique. Unlike traditional index funds that simply track the market, this ETF actively sells covered calls on the underlying stocks, which can generate additional income and potentially boost returns. Plus, it's managed by Global X, a company with a proven track record of bringing innovative ETFs to market. They have a team of experienced professionals who are dedicated to providing investors with the tools they need to succeed. If you're looking for a low-risk way to boost your returns and add some excitement to your portfolio, the Global X NASDAQ 100 Covered Call ETF might just be the perfect fit for you. Next up, we have the Invesco QQQ Trust Series 1 ETF. Now, I know what you're thinking. Another ETF focused on the NASDAQ 100. What's so special about it? Well, let me tell you. While many ETFs simply track the NASDAQ 100, this one takes things a step further by focusing on the top 100 companies in terms of market cap within the tech sector. That means you're getting a highly concentrated portfolio of the biggest and best tech companies out there. And let's face it, tech is one of the most dynamic and innovative sectors in the market today. It's home to some of the most exciting companies and is poised for continued growth in the years to come. But you might be wondering what makes this ETF stand out from the crowd. Well, for starters, it's got a super low expense ratio of just 0.6%, which means you're not paying a lot of fees to own this ETF. Plus, it's got a relatively high dividend yield of 1.23%. That may not seem like much, but considering the growth potential of the tech sector, it's a pretty solid return. But the best part about this ETF is its performance, with an average annual return of 20.99% over the past 5 years. This fund has easily outpaced the S&P 500, and that S not just because it is focused on a hot sector. It's also thanks to the fund's smart weighting system. Instead of giving each company an equal weighting, this fund assigns weights based on market cap. That means that the biggest companies in the sector have the biggest influence on the fund's performance, which has proven to be a winning strategy over the long term. Overall, the Invesco QQQ Trust Series 1 ETF is a great choice for investors who want to tap into the growth potential of the tech sector without having to pick individual stocks. Its low fees, high yield, and strong performance make it a compelling option for any investor looking to boost their returns. All right, now let's talk about the Franklin FTSE China 25 ETF. This ETF gives you exposure to some of the fastest growing companies in one of the world's most dynamic economies. But you might be thinking, China, isn't that a bit risky? Well, let me put your mind at ease. Despite recent tensions, China's economy is still growing at a rapid pace, and its companies are leading the way in innovation and technology. Plus, this ETF focuses on large-cap companies, which tend to be more stable and less volatile than smaller companies. But what really sets this ETF apart is its focus on the consumer discretionary sector. That means you're re-getting exposure to companies that are poised to benefit from China's growing middle class, which has a ton of disposable income and a taste for luxury goods and services. Not only that, but this ETF also screens out companies involved in controversial industries such as gambling, alcohol, tobacco, defense, and weapons. That means you're getting a portfolio of companies that are not only growing quickly, but also operating in a socially responsible manner. Now, you might be wondering how this ETF compares to other China-focused ETFs, and the answer is pretty simple. It's got a low expense ratio of 0.59%, which means you're not paying a lot of fees to own this ETF. Plus, it has a decent dividend yield of 2.58%. And let's not forget about the performance. Over the past 5 years, this fund has delivered an average annual return of 11.79%, which may not sound like a lot, but considering the volatility of the Chinese market, it's a pretty solid result. Overall, the Franklin FTSE China 25 ETF is a great option for investors looking to gain exposure to China's booming economy in a socially responsible way. Just remember that investing in emerging markets always carries a bit of extra risk. But if you're willing to take that risk, this ETF could be a great addition to your portfolio. All right? Now let's talk about the VanEck Vectors Video Gaming and Esports ETF. This ETF gives you exposure to the hottest trend in the market today, the gaming industry. As more and more people spend their free time playing video games, the companies behind these games are seeing explosive growth. This ETF tracks an index that includes both established gaming companies and up-and-coming players, giving you a well-rounded portfolio of some of the most exciting companies in the gaming space. But what's really interesting about this ETF is its focus on esports. Esports is a fast-growing segment of the gaming industry that involves competitive video gaming, and it's become a major draw for fans and sponsors alike. By investing in companies involved in esports, you re-getting in on the ground floor of what could be the next big thing in sports entertainment. Now, you might be wondering how this ETF compares to other gaming-focused ETFs, and the answer is pretty clear. It has a low expense ratio of just 0.57%, which means you're not paying a lot of fees to own this ETF. Plus, it has a nice dividend yield of 1.06%. And let's not forget about the performance. Over the past year, this fund has delivered an impressive return of 27.34%, making it one of the best performing ETFs in the market. Overall, The Vanek Vector's Video Gaming and Esports ETF is a great option for investors looking to capitalize on the explosive growth of the gaming industry. Just remember that this is a relatively new ETF, so it's important to do your research and understand the risks involved before investing. And last but not least, we have the Invesco Solar ETF. This ETF is focused on the solar energy industry, which is one of the fastest growing segments of the renewable energy market. As more countries look to reduce their carbon emissions and move towards sustainable energy sources, the demand for solar energy is skyrocketing. And this ETF gives you exposure to some of the biggest names in the solar energy space. This ETF tracks an index that includes companies involved in the production and distribution of solar energy products. That means you're getting exposure to companies at various stages of the solar energy supply chain, giving you a well-balanced portfolio. Now, you might be wondering how this ETF compares to other renewable energy ETFs, and the answer is pretty straightforward. It has a low expense ratio of 0.59%, which means you're not paying a lot of fees to own this ETF. Plus, it has a decent dividend yield of 1.44%. And let's not forget about the performance. Over the past year, this fund has delivered an impressive return of 25.95%, making it one of the best performing ETFs in the energy sector. Overall, the Invesco Solar ETF is a great option for investors looking to capitalize on the growth of the solar energy industry. Just remember that investing in the renewable energy market can be a bit risky, as the industry is still relatively new and the technology is constantly evolving. Well, that's a wrap on our list of 5 game-changing ETFs that are sure to supercharge your investment strategy. Don't forget to hit the like button if you enjoyed the video and subscribe for more investing insights. Thanks for watching and happy investing.